So, Peter, your investing philosophy is often summed up as buy what you know. And there's some truth to that, and it's also often way oversimplified.
Sure.
Can you explain what you did mean by that and what you didn't mean?
Well, it bothers me that people are very dangerous when they invest. This word play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or to party. That's dangerous.
So when you say buy what you know, you also thought that the regular investor might be able to get an inside advantage by sticking to an industry he's familiar with or seeing something that she realizes is a great product.
Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot. You would have seen Limit when it was hot. You would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. And then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20. You know, they can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. But you don't leave the mall, though, and buy that day. You have to do some more work.
That's the important point. Another point you've made, and this is, I think, particularly relevant 10 years into a bull market, is that I think you said more money has been lost anticipating a downturn than actually in the downturn. Can you explain?
Well, obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whatever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
And is that the one that happens most often?
Yeah, well, unless you're working hard. If you're working hard, you're always checking with competitors, you're checking with customers, suppliers. You're trying to do work to find out, is this company still early? Do they have years and years of growth ahead of them? Then you stay with it, no matter, even if the stock goes down.
There's also this idea of never invest in something you don't really know. That was part of it. That's why you went out on the road so much.
Right.
If I don't understand it, I don't want to.
Yeah. The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you can call the psychic hotline. But if you don't understand it, you're probably going to do the wrong thing. You know, if you understand exactly what they're doing, it's gone from 10 to 6, you'll buy more. If you're confused to start with, you'll say, well, there must be something wrong there. And then you're out. And then a lot of times stocks are going to decline. I mean, some of my best stocks have gone from 18 to 8, then to sometimes to 40, and some have gone from 18 to 0. But at least I wasn't adding to it on the way to 0. A lot have gone to 0.
So if it's going down, you're not adding to it? I mean, sometimes you are.
If the fundamentals are getting better or the same.
But
if they're deteriorating, I'm going to leave.
What has changed about investing in the market since you left in 1990? What has changed?
Well, I think there's a lot of this computer-driven things, where people buy stocks for a second and own it for a second. I mean, I think that's a waste of time. I think it's disruptive. On the positive side, information to the public is so much more available today. When a company releases their numbers and they have a call, it's open on the web to everybody.
Right.
All the information. We used to wait for the mail to come to see what Nike's inventories were like. I mean, you find out we get in our library in the first class mail. So all this information. So the investing for the average person now is much clearer. They know the same thing as I do.
Yeah.
They have all this, you don't want to invest in a company whose balance sheet is, they got $8 billion in debt and they have no cash and they're losing money. That's a terrible combination. You get all the information now. So information is a lot better than it was, a long time ago.
You still believe in the investment mantra that you were often credited as your mantra, which is invest in what you know.
Yeah, I'm amazed if somebody. Imagine you spent you a long time in your field,
yes.
in my field. Imagine if you were in a mall the last 30 years.
Yes.
You would have seen the Gap. You would have seen Best Buy. You would have seen Circuit City. You would have seen these companies that are crowded doing something better, and they're buying biotechnology stocks or oil companies. It makes no sense to me. If you're in the steel industry, you see it go from awful to better.
Yeah.
Why don't you buy a steel
Yeah, but we
stock?
expect mutual funds to know that stuff. No, obviously.
Well,
I mean,
but-
if you're managing,
but they're ahead of us.
You know, if you look at Magellan or you look at BlackRock, you think they must have access to the best information in the world.
But they don't have that. They're not in the steel industry. They don't see things get better. You know, the way they don't see the chemical industry turning as soon as the people in the chemical industry do. I mean, you could be in the plastics fields or lithium, whatever it is.
People in the business see it first.
And that they see it first. Or they're
But
in a mall.
go ahead.
In a mall, imagine the companies you've seen, the Dunkin' Donuts. It goes on and on. Walmart, you know, Stop and Shop. These are all companies that really got better. And somebody said, gee, I'm shopping there. But I'm not saying people should, if they want to invest, they ought to do the same kind of research they do when they buy a refrigerator. Or they take a trip to Italy. Do some homework.
Is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company. It was just so overpriced. It went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now, fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you were just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
In the stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years from now, common stocks are a place to be? If you believe in that, you should have some money in equity funds. I mean, it's a question, what's your tolerance for pain?
Your philosophy is simple, and I'm remembering this from the previous book. I think we're now talking about the previous book.
Correct.
Your philosophy was, if you find something that you identify with. I remember there was a story of your wife and her hose.
Yeah.
Your wife kept saying,
these are legs. Oh, you got it.
Yeah, the legs and panties. Your wife said, these are the greatest things I've ever seen.
Right.
And when your wife said that, you knew that this was a product that was better.
Right.
You used to stay at La Quinta Motel.
Right.
And the service was better, whatever was better.
Right. The price was good.
And
too.
the price was good too. And you said, this is a place that I can determine.
Right.
I, Peter Lynch,
Right.
can tell that this is a good product, right?
That's right.
And if these people are making a good product,
That's
then their earnings are going to go up, therefore the stock's going to go up.
Right.
And that's the kind of decision-making process you ought to go through.
Right.
Do I have it?
You've got it exactly right. Well, I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. if the company, McDonald's has done very well as a company.
Right.
The stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
It's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
But what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yeah.
If we're in a recession, people are not going to spend
That's
as
right.
much money on going to the movies
Absolutely.
or whatever they do.
Right, right.
And therefore, you got to pay attention to these other things
Yep.
because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to
He
tell
can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now.
Right.
So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
Here's a quote from you. I own Dunkin' Donuts. When you own Dunkin' Donuts, you don't have to worry about Korean imports. You don't have to worry about M2 or M3. These are money supply figures,
Right.
aren't they?
Yep.
And what's happening to the money supply? This is the way you make money. If you don't understand what the company does, you should not be in it. If you could predict the stock market, you could predict the economy, you could predict interest rates. If you go buy the wrong stocks, you're going to lose half your money anyway.
Right. I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Yeah.
People are in industries. They're in the publishing industry. They're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need in a lifetime? Instead of people that are in the restaurant industry, they're buying biotechnology stocks.
Right.
The people in the chemical
know
industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going to go out and try it. But people are buying stocks anyway.
Yeah.
They're not discouraged. They just think it's a gamble.
Yeah.
So therefore, they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it, and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
Yes.
don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
What do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what all these things are with auto back planes and mega flops? Who knows what all these
So buy what you know.
Buy in your industry, buy what you know, buy local companies.
Yeah, so suppose you don't have an industry. I mean, you don't really...
You buy local companies, companies in your own industry. 10 years after Walmart went public, 10 years after it went public. 10 years after it went public. It's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. 50 times.
If you bought it 10 years
After it was public already.
Yeah.
It had already gone up 5-fold. So you could have made 250-fold. But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains, and you checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country, they're not even saturated there, why can't they go to the rest of the country?